NCPI-based year-on-year headline inflation slowed down to 0.1% in October 2018 compared to 0.9% in September 2018. This marked the lowest headline inflation since January 2016. The lower food prices that prevailed in October 2018 compared to the previous year contributed to this low headline inflation. However, the year-on-year inflation in the non-food group was seen to be increasing, mainly due to the price increases in expenditure in transport, miscellaneous goods and services categories. Meanwhile, the year-on-year core inflation, which reflects the underlying inflation in the economy, increased to 3.4% in October 2018 from 3.1% in September 2018. Moody's Investor Service downgraded the government of Sri Lanka's foreign currency issuer and the senior unsecured ratings to B2 from B1, whilst changing the outlook to stable from negative. Moody's stated that the ongoing tightening in external and domestic financing conditions and low reserve adequacy, which was aggravated by the recent political crisis, had heightened the refinancing risks more than that was envisaged when a rating of B1 with a negative outlook was affirmed in July 2018. The political situation had also resulted in a delay of the disbursements planned under the IMF program, where a prolonged pause would likely to undermine investor confidence, worsening the tightening financing conditions. Moody's projected the foreign exchange reserves to remain between $6.5 billion to $7 billion in the coming years, lower than that which was forecasted in July 2018. It was stated that a steady and credible implementation of planned fiscal and economic reforms would improve Sri Lanka's ability to sustain investor confidence, although the recent political events have interrupted the reform momentum. However, Moody's, despite the current political crisis, expects any future government to remain broadly focused on the implementation of important fiscal, monetary and economic reforms that would strengthen the credit profile over the medium term. Furthermore, Moody's believes the broad direction of policy would remain focused on gradually narrowing fiscal deficits and lowering government debt, which is also largely anticipated to be independent of political shock. Meanwhile, in response to the rating action, the central bank stated that Sri Lanka's macroeconomic position had neither deteriorated nor had there been any policy slippage since Moody's decision in July 2018, even with the recent developments in the country's political sphere. The central bank stated that the current level of the gross official reserves of $7.2 billion is sufficient for the country to meet its external debt obligations. In addition, the central bank has initiated measures to strengthen reserves, such as entering into negotiations with other central banks to obtain foreign currency swap facilities of sizable amounts, issuance of Sri Lanka development bonds of nearly $750 million to $1 billion during the remainder of 2018 and early 2019, enhancement of nearly $500 million in addition to the $1 billion syndicated loan received from the China Development Bank. In addition, disbursements from bilateral and multilateral agencies could further strengthen the buffers by nearly $600 million. Moreover, the domestic financing conditions have shown considerable improvement through debt management strategies introduced recently. Evidently, this has reduced the rollover requirement of T-bonds and Sri Lanka development bonds in 2019, 2020 and in the medium term. These developments, along with resource availability among institutional investors, suggest that considerable headroom is available to meet Government of Sri Lanka's financing requirements from the domestic market. Thank you for tuning in, and do join us again next week for another update.